Now, but what's kind of sliding away is the rupee, because there's no stopping it. We thought 85 is the level and a crucial level to watch out for. Now we are threatening around that 85.30 mark. To understand rupee and of course what's happening with the economy, we have Aditi Nayar, the chief economist at ICRA, joining us on the show right now. Aditi, hi. Thanks so much for making time for us. Good afternoon and season's greetings. Well, the slide of rupee has actually accentuated in the last couple of weeks. And I'm not sure, is it just, coincidence, or is it just the timing with the new RBI governor coming on board? Do you think anything has changed in the RBI policy in terms of management of the rupee and the forex reserve?
Thank you. Well, it's really a global phenomena right now. EMs are all getting hit. The dollar is quite strong, and if you see the way the DXY is moving, it's no surprise really that we're going to get some weakness coming in with the rupee. Having said that, the INR has still been one of the strongest performing EM currencies in the recent period, and I don't think that there is any necessary change in the policy as such. It's really more a reflection of what's happening globally and the dollar strength which has come in. I'm afraid we may be in for a period where there could be such continued volatility going ahead as well, given the fact that there is a lot of policy which is kind of being reset ahead of the US presidential transition as well.
Volatility indeed, but is there a level that we should keep in mind for dollar index, because that has strengthened beyond 108 again, and even for rupee? Do you think sudden weakening of a couple of bucks is not ruled out?
As of now, we're looking at the rupee probably remaining in a range of 85 to 86 until the budget is presented, and this is going to take care of the Trump presidency transition as well. And once the budget is presented and we have clarity, or at least some clarity on the US policy front, although possibly we are in for a year where there could be a lot more volatility and a lot more changes as compared to what we've seen in the past coming in from the US, especially until there is more clarity on what's going to happen with tariffs. Are they going to be applied universally or applied more specifically on some countries? That uncertainty may continue for some time. And of course, with the budget, there are a few specific things that we're looking forward to, both the fiscal deficits for this year and the next, as well as the medium-term fiscal path that will get unveiled for the fresh medium term. So our sense is that in the month of, in the rest of December and in the month of January, possibly we should be prepared for rupee being in the range of 85 to 86, and then we take a fresh look at what levels seem likely after that.
Right. Also, Aditi, now that Trump has come back to power, it's going to be dollar supremacy, or at least his policies are going to speak about take a dollar first approach, and he's already made that clear. But if that happens and the dollar strength continues, then can we expect the rupee to depreciate further? And if that happens, then what happens to the imports, the trade deficit, and then the inflation as well in the country?
All of this is going to get impacted by the level of the rupee. As of now, I can share with you what our baseline forecasts are for FY26. We're looking at a GDP growth of 6.5% each in FY25 and FY26. We're looking at the CPI inflation moderating hopefully from about 4.8% in FY25 to 4.2% in FY26. With this growth inflation balance, we think that the RBI would be able to go in for 50 basis points of rate cuts, either spread between February, April or April, June. And on the current account deficit, if we take the November trade deficit as per the initial level that was indicated a couple of weeks back, then we're looking at a current account deficit of 1.3% of GDP in FY25. And our baseline for next year right now is actually 1% of GDP. So a very, very comfortable level. And while tariffs can, of course, upset the apple cart a little bit, we don't expect the current account deficit to really get to levels which are very alarming. Max between 1 to 1.5% of GDP is what we're looking at right now.
Aditi, I want to come back to the point that we're talking about, the couple of points that you're watching out for in the budget, especially the fiscal deficit glide path. Now, there's part of the street which believes that perhaps they can take a bit of a detour from glide path, given the fact that consumption and mass, sector is what is hit. Would you concur that there is a case to be made that the government spending needs to be increased, and perhaps fiscal deficit glide path could be stable and not really contracting for now?
look, my sense is that in FY25 we're going to end up with a fiscal deficit that is slightly below the targeted 4.9% of GDP because capital expenditure has not taken off the way that we expected it to even in the months after July. So possibly there will be a shortfall in terms of the capex target, and that will help us to keep the fiscal deficit below the targeted 4.9% of GDP. For FY26, I think it will be quite important to show commitment to the fiscal consolidation glide path, which was indicated earlier. So 4.5% of GDP or thereabouts is what we're expecting. Ultimately, what spending is increased is also important, right? So whether we're going to be looking at more of subsidies or welfare schemes or capital expenditure, each of these is going to have a different impact and multiplier on the overall GDP growth. My sense is it's going to be important to stick to the fiscal consolidation glide path, and we're also looking forward to the contours of what the new medium-term target is going to look like. We understood from the last budget that we're going to be possibly shifting to looking at the debt to GDP as an indicator instead of a point estimate on the fiscal deficit to GDP. So it'll be quite interesting to see the contours of how the new medium-term fiscal paths are enunciated.
Okay, important to stick at least to the medium and the long-term targets, even if for a year they might just miss it mildly. But what's your own, channel check suggesting with respect to the consumption in the country? Because the data that we got from Q2 earnings wasn't great. The data that we're getting on a, high-frequency basis, whether it's toll collection, whether it is energy, whether it is, of course, car sales, there seems to be a problem which is continuing into December as well. Are your channel checks different, or are they recommending the same?
See, when we look at our ICRA Business Activity Monitor, which is a compendium of 16 high-frequency indicators, the average growth for October-November of 2024 is actually quite a bit better than for Q2. And even into December, we have a little bit of a mixed trend, but some things are looking better. Like, for instance, electricity generation growth has improved steadily from October to November to December. And overall, my sense is that we will end up getting better growth outcomes in H2 as compared to H1. Some of the temporary factors that were acting as headwinds on the Indian economy in H1 will go away in H2. We have, some specific factors like on the rural side, we think that sentiment will be a lot more steady going ahead after the outcome of this monsoon and the combination of the Kharif output, the Rabi sowing, which is on track with last year, and reservoir levels, which are a lot better than last year in many parts of the country. Urban consumption is something that is likely to remain uneven, both in terms of a goods versus services approach. Possibly services will still see better demand than goods. And also on an income basis, we expect the high income, high net worth cohort to continue to show high consumption growth, although the multiplier impact of that may not be that great. And middle income cohort in particular tends to get quite impacted by the inflation outcomes, as does the lower income segment. So there we expect an unevenness to continue on the urban side as well.
All right, Aditi, thank you so much for taking the time out and joining us. We will let you go on that note. But moving on then, 2024 on